I'm Spencer Israel here with Ian Culley, head of fixed income, commodities, and currencies at All Star Charts. I know today Ian's got a few of his favorite charts to discuss, and also a key warning sign or an asset that could be a warning sign for the stock market. But before we get to that, Mr. Culley, let's get to our FICC market recap here. What's going on in the world of FICC land?
You know what's really caught my eye is the resiliency in gold. So gold, first chart here, gold, finding plenty of overhead supply here on those former all-time highs around 2089. It's been selling off over the past few weeks. It's interesting, it's finding support at a logical level here around 1965. Between 1965 and 1980 is the zone. Look at all of this contact points. I mean, this level used to this is a former resistance level for the past couple years, and now price is finding support. So as long as gold futures are holding above this level here on 1960, I just want to err on the side of further upside for this shiny yellow rock. When we zoom in, you can just see these past few days. Last Friday, bulls came in, repaired the damage, Thursday's damage that undercut the pivot high from February, pushed prices back above, and now it's just kind of chopping sideways. Today, relatively flat, and June contracts trading around 1971 as of this recording. Very impressed given the weakness in silver and the weakness in gold mining stocks. This is the gold mining miners ETF GDX. Like silver, it undercut a key former resistance level that had turned into support earlier this year. So the path of least resistance is lower for gold mining stocks. Still higher for gold, but the miners are in a bit of trouble here. Now, buyers need to step in, bid these stocks up, and reclaim this 33 level. Now, when you zoom out, you could argue that 30 is the bigger level here. Now, this is a monthly candlestick chart, incomplete monthly candle here. This final, the most recent red candle. So keep that in mind. Not gaining any insight into the candles themselves, but we're just highlighting. I want to highlight this 30 level. So as long as the miners are above 30, they're hanging in. They're hanging in. But again, the bulls need to step in and drive prices higher sooner rather than later. And then when it comes to GLD, the gold ETF, that level's 181.50. Holding in there now. So again, as long as above 181, 181.50. Looking good for gold. It's actually looking good for gold. I know a lot of people might not say that right now, Spencer, but I think
the last last month or so, hasn't been great. It
hasn't been great, but we got to remember, look where we came from.
I know. Yeah.
Look at this rally off of the October lows.
Yep.
What peaked late September, early October? The dollar, right? Dollar peaked.
That's a funny coincidence there.
Funny coincidence how that works. And now we're seeing some dollar strength. So it makes sense to have some near-term weakness in the precious metals. Now moving on to crude oil, also hanging in there, right? Also finding support at a key level that acted as resistance in 2019 and 2020. Again, as long as crude oil is above the 65 level, I've been highlighting it for the past couple of weeks. Here we have a zoomed in look here. And then today, crude is back above this 74 level. So got a 74 handle around 74, down to 74.18, but as high as 74, almost 74.50 earlier today. So the bulls are definitely supporting higher prices in crude. So USO, that level is 58. As long as USO is above 58, gotta give the bulls the benefit of the doubt. And moving on to copper. Well, Dr. Copper, not getting the same kind of love crude oil is getting right now. At least not from the bulls' perspective. Copper breaking down to fresh lows this morning. It's trying to bounce back a little bit mid-session, but copper on the rocks. This is, global growth, economic barometer for global markets. You see copper continue to print fresh lows. It really raises doubt in terms of seeing a healthy rotation out of tech stocks and into those industrial and material names, which is what stock market bulls want to see if we're going to be above 4,200 in the S&P 500 and climbing. So keeping an eye on copper futures, whether you trade it or not, a lot of information. Now, FCX,
the largest copper miner.
Yeah, FCX hasn't broken down yet. But what's interesting is you do look at the, mining stocks, base or not so much the precious, but we look at more of the industrial names and areas of the market. You see these multi-month, 6-7 month topping formations. Some of them are resolved lower, some have not. Freeport McMoran, bellwether copper miner, has not resolved lower. That's a positive sign for stock market bulls, for certain. Keep an eye on FCX. Now on to rates. Now, Spencer, I took the downward sloping red arrows and question marks off the chart.
Why?
Because rates they're showing no signs of rolling over. As much as I might want to think they are likely to roll over in the coming weeks and months, it's just not happening. They continue to chop sideways. Still left those couple little yellow circles here on the 5 and 10-year yields, just to show that they tried. 30-year wanted nothing to do with it. So the rates continued to chop sideways, catching higher. And 20-year T-bond ETF TLT starting to catch lower, which makes sense in that environment. So this is a great picture of, or a great representation of the charts across the bond and fixed income spaces. That's just positive, constructive basing process underway. No upside resolutions. If and when TLT is above 109, it's called 110. Path of least resistance is higher towards 120. If and when we get it, I think it's just a matter of time. But that time is not now. It's not today. Interestingly, stock market does not care if rates are catching higher or lower. I think they're just perfectly happy with rates turning sideways. I think the stock market just doesn't want to see big moves in bonds, a high volatility environment in the fixed income space. They seem perfectly happy. Here we got the growth versus value ratio catching higher. Recently printed, was it 52-week highs? Recently hit 52-week highs, while the bond ETF TLT continues to base. So interesting decoupling here of a strong positive correlation. You can see it extremely negative at the moment. I imagine that these two lines do resolve ultimately in the same direction, just a matter of in which direction that will be. Will stocks fail to hold? Will growth? Will communication sector? Will the tech sector fail to hold their recent breakouts? Those base breakouts fail, and we see growth start to catch lower relative to value, and bonds continue to fall? Or is it the other way around? Do those base breakouts hold, and ultimately bonds break out following tech and communications? Well, we'll just have to wait and see. So if we're talking about rates, talking about the 10-year yields in general, talking about the dollar, kind of go hand in hand. And this positive 126-day rolling correlation here in the lower pane really highlights that. I mean, these things have just been in lockstep practically for the past year and a half. You can see dollar catching higher and rates continuing to hold. So dollar index fund UUP ETF is getting close back to those pivot highs from March. Comparable pivot highs in the dollar index is 105. Got near 104 yesterday. But again, this above 105, and I think risk assets in general are going to be under increased selling pressure. Well, UUP is getting close. It's getting after it. So keep an eye on UUP. I want to see if there's maybe a little bit of lead here. See if this ETF leads the index. No real data suggests that will be the case, but definitely an ETF I want to keep my eye on for that information. Again, no oversold readings on UUP or the dollar index. As you can see, UUP is getting close to printing another overbought reading. Gotta imagine stocks are again coming under risk, or excuse me, coming under increased selling pressure in that environment. Also threw in the US dollar index seasonality chart. As you can see, May is a good month for the dollar.
Well, May's almost over, so let's look forward here.
Yeah. But
June,
it's interesting to see that on average, the dollar gains what, 0.5%. Most May going back 44, almost 44 years. This month it's gained almost 2%. It's up near 1.8%.
Wow.
So it's had an abnormally strong month. So keep in mind, not nearly as bullish next month. Maybe that strength comes off. Maybe it got a little ahead of itself. We'll see.
Interesting that the dollar has had such a strong month, and yet the stock market, I mean, in particular, the growth part of the stock market, tech stocks, have also been strong. Very, very interesting. You wouldn't expect that. But,
no, not at all.
But here we are. Okay. Do you have any favorite charts for us today?
Yeah, I got a few. I brought first one, Kinross Gold. This is a KGC. This is a $1 billion gold mining stock. What I love about this is it really hasn't been on my radar for the past 4 or 5 months. It just hasn't been the strongest name out there. It's interesting, in the past few weeks, you're getting a relative breakout. 52-week highs on a relative basis, relative to GDX, the broader gold mining ETF. So seeing some relative strength. We also got a breakout here of a critical polarity zone that was marked by the key pivot lows from 2022, early pivot high from January here 2023, and now it's continuing to hold just above that level. I checked about it 20 minutes ago. It was holding around 497 early in the session. But as long as it's above 490, 475, I like Kinross Gold, KGC long, with an initial target up around $7. It's not a whole lot of gold mining stocks that look like this. I mean, Newmont, the bellwether, is revisiting its March lows, not even close to trading above its January pivot high earlier in the year. So really like the relative strength coming out of Kinross Gold here, KGC.
Anything else?
Next up, I shared this chart with readers yesterday. It's a triple pane chart of the dollar yen, the US dollar index in the center, and the US 10-year yield on the lower pane here. And this is just an extension of what we were talking about earlier with the dollar and rates. But you can see here, these three charts are just they've been moving tick for tick with each other for about 1.5 years, much like the dollar and the 10-year yield. And a lot of that has to do with the Japanese, the Bank of Japan yield curve control policies, capping that their 10-year yield around was 0.25%, 25 basis points. And I think now it's 50 basis points. But you combine that with Japan is one of the largest holders of US Treasury bonds. And those two key ingredients have really created this strong correlation between these three charts. And from the looks of it, I don't see this relationship breaking down. So Japanese yen breaking to new highs, completing a bearish to bullish reversal, raises the question, are we going to see a bearish to bullish reversal in the dollar and the US 10-year yield. So keeping an eye on the yen. And if you trade these markets, I like it long above 137.50. As long as it's above that level, initial target around 142.50. And it's it's a positive carry trade, so you get paid for holding it, which is great.
There you go.
And then my final chart today, we're talking a lot about crude and seeing some strength in crude. I brought the crack spread. This basically, when I look at the 3-2-1 crack spread, I'm just looking, for demand. Are we seeing demand in the distillates? What crude is refined into? And if you're seeing demand, if you're seeing a widening spread here, this line rising, that speaks to increased demand, which directly affects the price of crude. And you can see here, it's starting to widen again. Crude starting to catch higher. If you're looking at the board today, metals are under pressure, dollars rising. Both industrial and both industrial and precious metals. But energy's in the green. Crude again back above 74. Natty gas is catching higher, but more importantly, gasoline's above 250 and heating oil is approaching 240. So positive developments for crude. Definitely has my attention.
All right, so those are your favorite charts. We also like to highlight charts that maybe aren't your favorite right now, but are flying a little bit under the radar. Do you have any sleepers for us today?
I gotta talk about natty gas.
Okay, UNG.
And I think natty gas is a sleeper, and that's really the point that I want to make. I really liked buying this off these 2020 lows, stepping in and taking a shot at natty gas after that just steep decline. You often get a strong snapback, right?
Wow.
A reversion to the mean, if you will. And we saw that rose up around $3 earlier this year, and then again sold off to make fresh lows. And I look at this chart zoomed out over a decade, and natty gas just needs more time, in my opinion.
Okay.
Just needs more time to base. I mean, it's a good looking chart. I think, maybe later this year, next year, we get back up around $6, but definitely keep natty gas on your radar. And if you're a longer-term investor, from a longer-term perspective, I don't see any reason not to jump in and go ahead and start taking some positions in an ETF like UNG. I got an email from a client earlier this week asking about UNG and what I thought about going ahead and getting long. And again, it's just, you got to know who you are as an investor and what is your time frame. Personally, I don't like getting long UNG or below 736. It's called 750. Below 750, and I think UNG continues to chop sideways. It still has a lot of basing to do. And I just don't have that personality to hold on to an asset that's going to potentially be in the red for months and continue to churn before eventually showing some gains. So, and that's just me. But if you look at it like, hey, this is a great place to get in.
Yeah.
I'll put it aside. I'm not even going to look at it. Don't worry about it. In a year from now, it could be at 20. So right. It just depends on who you are as an investor.
Let's move on to our main segment here. I called today's show a warning sign for the stock market. Ian, you're looking at the dollar Mexican peso currency pair. Explain why that is a warning sign.
Well, what's interesting is the dollar Mexican peso pair in the S&P 500, the VIX, volatility, it's an extremely strong positive correlation. And you can see that here in the lower pane of this chart with the 63-day rolling correlation. and it's strong today. So when I look at this chart, I see the dollar Mexican peso as critical insight in the direction of volatility in the U.S. stock market. And what's interesting about the dollar Mexican peso is that it's finding support at a critical level, or a logical level, I should say, around 1750, which marks the 2017 low. Now, zooming in, you can see that it also hit oversold condition and have starting to bounce higher. It's similar situation back in March, early March. Remember, in early March, the S&P 500 actually bottomed and began to rip higher. Also in November, we saw this divergence here, hitting oversold. Remember, you got a strong sell-off. Right? So volatility doesn't necessarily speak to the direction of where the S&P 500 is heading, but it does speak to a directional move, most likely in the cards. I love this chart. This is probably my favorite chart from JC's presentation last week. In the lower pane, you have the Bollinger Band width, which is a measure of volatility. I believe it's 2 standard deviations. And when we're looking at the bottom, it's coming down to a level, it's contracting, they're getting tight, which speaks to an extreme low volatility environment. And notice in the past, as volatility expands, as it contracts, it eventually expands, much like price action. And when volatility does expand, it usually results in a directional move in price. Whether or not it's going to be, to the upside or to the downside, that's not necessarily the point. And even looking here at the chart, this most recently, you can see like price has just been chopping sideways. Bulls have just chewing away, trying to digest all that overhead supply to no avail. And we're starting to see a sell-off in the past couple of days. Price is starting to fall. And it just so happens that the US dollar Mexican peso is starting to catch up a little higher. I think the VIX is up around 20, 21. So if we continue to see the dollar peso rip higher, I think we're ultimately going to see the VIX and volatility increase as well. The only area of the only market we don't want to see increased volatility is the bond market. I wanted to make sure I shared this slide with everybody. Notice here that increased bond market volatility is not a good recipe for the S&P 500. So while the S&P 500, the VIX catching higher, the US dollar Mexican peso catching higher isn't necessarily negative, isn't necessarily a bearish data point. If bonds really begin to move, if we really begin to see a strong directional move in rates, and this inverted line here in the bottom continues to catch lower as it did most of last year, and I imagine stocks are coming under increased pressure. No sign of that yet, though, of course.
So apparently now I have to pay attention to the dollar peso pair as a potential a potential signal that volatility in U.S. stocks will increase, at least in the S&P 500. So, all right, good to know.
I think you can just pay attention to the VIX. Just pay attention to the S&P 500. I think it's interesting that we are starting to see a bit of some upside action here in the Mexican peso, which just speaks to increased volatility. That's really what's happening here.
Okay, so maybe the dollar peso is not the warning sign for the VIX, but it's the other way around, where it is, or as volatility increases, then so too will the dollar peso.
Oh no, what came first, the chicken or the egg?
I don't know. I still don't know after all these years. Okay. What else do we have? We have a question from the chat about he's asking about the junior gold miners, GDXJ. I don't know if you have a chart handy.
I do have a chart handy. Let me pull that up. Let me see where it is. I'm going to move this over here so I can find it.
And I also want to add, if you're watching the show on YouTube and you want to hit that thumbs up button, we would appreciate that very much. It does help us in the eyes of the YouTube algorithm. They like the likes.
Oh, algorithms.
And they're mysterious and they're all powerful and they run my life.
So many charts.
I know.
So many charts, Spencer.
Well, I mean, you don't necessarily need a chart of the GDXJ to be able to comment on it. I would imagine it's doing something similar to what the other gold ETFs are doing. No, I mean,
it is, and it recently took out a downward sloping trend line, which I wanted to share, which I think is interesting. I still think GDXJ is it's still basing. It's still basing like a lot of the miners are individually. So it needs work. The whole mining space needs work. My structural outlook for precious metals remains higher, even though I have to remind myself, gold hasn't even broken out yet. You look at all the other major currencies in the world, gold's hitting new all-time highs. I got an email the other day and it's about gold hits new all-time highs in rupee. Which is funny, but it's true. It's true. So the whole space still needs a lot of work. Still has a lot of work to do.
All right.
Yeah. I'm gonna find this chart.
We're Ryan R. Just rewind the show. We talked about copper probably 5 or 6 minutes into the show, maybe copper? 5 minutes to the show. So just rewind it for that. Okay, Ian, oh no, you have the chart. You want to bring it up?
Yeah, this is the chart. I got so many chart books. My computer's really slow. They want me to wipe everything and reinstall Windows, and I refuse. I refuse. So I need to do that this weekend. I keep putting it off, but here is the chart I mentioned. Okay. Again, this is that, it's breaking out or violating this 2-year, multi-year downtrend line. It's constructive. It's constructive. I'd like to see, GDXJ get back above this pivot high from April, from earlier in the year. Let's call it about 45. Back above 45. Next stop, next area of logical resistance comes in around 52, between 52 and 55, around that area, which coincides with the June 2021 high and those pivot highs from April of last year, which that kind of makes sense for me. But just to see the GDXJ has violated this downtrend line and is beginning to catch higher, is constructive for the entire space. Because these smaller miners just this is risk on. This is just an amped up version of GDX. So put this in the same bucket as silver.
All right,
that makes sense.
All right. Before we go, want to just remind everyone that you can always email us with any questions about anything related to FICC, fixed income, commodities, or currencies. You can email questions@stockmarketmedia.com. I will ask Ian those questions on the show. Also, wanted to just quickly promote a free thing that we do. It's called the Chart of the Day, All-Star Charts. Does this chart of the day. It's allstarcharts.com/ it's on the screen there, /chart-of-the-day. Go to that link, sign up. Ian Culley, part of that is seeing the markets for the chart of the day, and he helps pull that together. So get that. It's free. It's every day. And I mean, did I mention it's free? It's the best part, right? So check that out. You can always give All-Star Charts a call. The number is on the screen there to learn more, because Ian is part of the team that does the research for All-Star Charts. Obviously, he's their head of FICC, so he's doing all the research for the fixed income and the commodities and currencies and putting all the charts together. So call the number on the screen to see how you can sign up and become a member today. And that's what I've got. Thanks for watching What the FICC. Ian, any final thoughts?
Manage risk. Manage risk. Buy smiles, sell frowny faces.
All right. We will catch you guys for our next show on Friday. In the meantime, happy trading.
See you guys.